Hey, good afternoon, everyone. I hope you're all having a terrific day so far. Hello, Spider Monkey. Hey, Bill. Uh, we had quite a bit of action today, so we'll go over it. And there are some signs of concern inside this market right now. So we're going to go over all of that in addition to what we normally do in our afternoon. So uh, to start off with, I'll just go over what I said in my Telegram channel today, and that was that we are most likely going to chop between 623, 625 for most of the day, and we were pretty right about that, starting at 7:30, or I guess 10:30 Eastern time, all the way until the very last minute of the markets. We saw this rapid decline the last 3 minutes or so down to 622. So that sudden sell-off at the very last minute, it's not a terrific sign. If we see, for example, this day, the last couple minutes, sudden sell-off, we gap down. Of course, the next day we recovered, so it doesn't necessarily mean anything meaningful for the rest of the day, uh, it, but it's not a great, terrific sign. There are other things that are supporting that viewpoint as well, though. It's not just that sell-off for this morning. I've got a massive lag in my mouse, making it very difficult to navigate. So in addition to that, we're at some very important levels. And what I started noticing in the options chain right at the as that sell-off was happening, and right now, after markets, if we look at many of these large cap stocks, like S&P 500, if I go out to the options and look at the bid-ask spread, they're wider than normal. Microsoft should be a very liquid name at the money, and we've got 15 wide. That's not terrible. That's not too bad right there. I'm a little bit more interested in the closer expirations. And you can see that it's 15 wide over here, 20, yep, 15 wide over here on Microsoft. Let's take a look at Apple. Apple should be super liquid. And 10 wide right here, 15 wide, pretty close to the money. That's a little disconcerting for Friday expiration. And then if we go over here to, oh, that's not bad at all on the August. And if we go to slightly smaller names, that's where we start to see this bigger and bigger difference. So one of the active areas the past couple days has been defense. So we can see, oh, that's not too bad. Oh, right here, there, 40 cents right there. And then HWM, same thing, 40 cents, 50 cents. These were a lot tighter during the day. So the fact that we had market makers widen out their bid-ask spreads in the last minutes in conjunction with that sell-off, that is a signal that they're protecting themselves. They're starting to get a little bit concerned, and we may be able to see that in the VIX. So let's go over here to 1 minute VIX, and we can see that in the last 10 minutes or so, so actually preceding that move downwards by about 7 minutes, we'd see that VIX was already moving up. So market makers were ahead of this. And now after markets are closed, the VIX is still getting widened out. So that's not a great sign. This is definitely something that we'll want to look at very carefully in the morning. And there are other signs that we really need to be a lot more careful heading into tomorrow and the rest of the week. So let's take a look at those. So first, we take a quick look at the technical levels. S&P 500 made yet another all-time high. That was sold into, not heavily, but it was sold into. Our profits were being taken, and that meant that we closed flat, down 0.43%. But on a 2-week basis now, the prices for S&P haven't really gone anywhere. So we're basically exactly touching the EMA 8, the EMA 8 sitting at 622.05 and closing at 622.14. And I think even post market a little bit lower than that. Yeah, 621.37. So post market, we've gone through that EMA 8. So what we'll really want to see is tomorrow whether we resume this pattern of basically just chopping sideways, or we actually start getting a little bit of directional movement. Based on what I'm seeing right now in that last minute sell off, is a little bit more likely that we're going to actually have a little bit of direction. But if we even go down to the EMA 20, then it's really, we're not talking about a huge movement uh, intraday, because that would be, what would that? That'd be roughly, if we open at 621 and we trade down, this EMA 20 would be a little bit higher tomorrow. So let's call it 4 or 5 points. So 4 divided by 621 is about 0.6%. It's not anything to get super excited about, but it is indicating some weakness, and if it continues, we could fall forward. So if we see in the S&P futures tomorrow morning that the S&P has moved at least 0.3%, that's a pretty good sign that there's going to be negative sentiment inside of the market tomorrow. But of course, we would want to see that line up with all the major indices as well. So in the Dow Jones and in the NASDAQ and even in the Russell, we could take a look at that. That'd be something to watch out for tomorrow morning. Tomorrow, we also have PPI. And if this is what CPI did, CPI came in basically at consensus and slightly higher. And the initial reaction was, we don't really care. Let me see if I can get that in the pre-market. Okay, so about 5:30 right there. You see initial spike up, but then it just went right back to where it was almost immediately, just a few minutes later. And then bouncing around, going slightly higher. Then the sell-off came at the open. So the market isn't really reacting to the news. It's not really reacting to PPI, CPI, but it is something to pay attention to. So I would expect that if the market didn't have too much of a reaction on the CPI, it shouldn't have too much of a reaction on PPI, assuming that that number comes in basically where consensus is. And right now, I don't have any reason to expect that it'll be wildly off of the consensus. So if we resume this pattern tomorrow, then we could see further downward movement, and we finally start getting that pullback that we've been anticipating for quite some time. So if I look at the VIX, VIX is still at muted levels. We're still in a buy the pullback regime. So we just need that pullback. We need to wait for that pullback to happen, or either happen or finish happening. If I look at VVIX, it's chopping sideways, not really giving us too much of extra information. And then so one thing that I really want to look at today, rather than our normal, for example, gold, silver, well, we'll look at them anyways. So gold, silver, chopping side, we bounced a little bit back. If I look at silver, basically a chop sideways. I mean, yes, it's directional movement, but versus 2 days ago, it's basically just a chop sideways. And then if we look at gold, gold just chopping sideways, not really doing too much. And then bonds moving down a little bit. That's probably is a reaction to the CPI. And then what we really want to be cognizant of is what the bond market is pricing into in terms of rate cuts. And this probably didn't do any favors in terms of having a rate cut soon. So September, July, we're basically not even, that we moved, so even less likely that we'll have a rate cut, but I mean 94-ish% to 97.5%. That's not really, we're no surprises, right? We're not changing our opinion if we go from 94% certainty to 97.5% certainty. So what I want to see is that change in September. And that's where we see a larger change. We went from 60%, 61% a week ago, down to 59% yesterday, down to 54.5% today. And that is, again, not an entire change of opinion, but it is more significant at this level than it is when we go from 94 to 97%, a change from 59% down to 54%. That's more significant. So the market's still kind of not really decided on whether or not there's going to be a rate cut in September. About at this point in time, the odds shifted back to, yeah, we increased to no rate cut. So this was a bigger shift, a more obvious shift, from 37 up to 44%. So the market pricing in now a lot less likelihood that we're going to have that rate cut in September. And based off of just CPI, when I say a lot less, that's relative, right? It's okay, we're only talking about 5 or 7 or 8 percentage points here. But relative to yesterday, that is a significant shift. And that these bonds, what I want to be aware of, I want to watch out for is whether or not this just resumes a downward trend because of that. And does PPI support that and start driving that even further down? So one thing that I really wanted to show you guys today that is important to look at is this guy right here, NAIM, National Association of Active Investment Managers. Good morning, Barry, or not morning, what am I saying? Afternoon, hey, Barry. Hey, Tim. I wonder if the sell-off has anything to do with China banned with selling some EV battery technologies. I doubt it. I don't think that is going to hurt. That will hurt a sector. Yeah, that might affect a sector, but I don't think that is entire market-wide type of news. That's not going to completely form and shape economies overnight. So I don't think that would do it by itself. Yeah. So let's take a look at these guys. The NAIM, basically what we're saying is people who are professional managers and are registered with this association, how much exposure do they have to the US equity markets? And this is so basically is how allocated are hedge fund managers to US stocks. And you can say, like, well, how do you get above 100% exposure? It's because they include the leverage, so that you can be leveraged a couple 100%. So that means that, it can go higher than 100%. But what we see here is right here that the latest, or one of the most recent numbers at the beginning of July was 99.3. That's pretty high. And then if we go over here to July 9th, that was, well, we haven't gotten this week's number yet. So we'll probably get that in seven days from July 9th, which would be maybe tomorrow or the day after, we should get that number. But what we're seeing is that this is a local peak, and this is a local peak, so not super meaningful yet. But if we see this continue to move down tomorrow or Thursday, whenever the number comes out, then that is a sign. So what we see here, I don't think my G Ink lets me draw vertical lines. Yeah, no, let me grab something else. I'll use the edge of this window. What we see is this is the S&P 500. This is the NAIM. These are professional hedge fund managers. And what I want to see is if when we get to an extreme level, like they're basically 100% allocated, then what happens when they start removing their allocation, when they start making room? Because they can't stay 100% allocated for, and as you can see, these numbers, they never stay above 100% beyond one print. So right here, it went down one, but then it went back up above 100. And from here, you can see that was an exact sell-off in the S&P 500 as they removed their allocation and they went more back into cash. They brought their allocations back down to 60. And then we had a little pullback right here. And then over here, again, so within a few days or a week, as these managers were selling off their positions and creating more cash all the way down to 55%, 56%, then we got another pullback. And then over here, not quite 100%, but if we go right there, just below 100%, they start selling it off down to 64%. And then here we have a baby sell-off, more of a chop sideways in the S&P 500. So the S&P was much more resilient over here, which means that retail was buying it up. Okay. But then that set us up for this one right here. And again, that's not quite as high. That's at 91.48. That's still pretty high, but it was not like 99 or 100. And then this one, they started making room all the way down to 35. And that was April. Okay, so that included so they already sold off ahead of Liberation Day. And then just a little bit after Liberation Day, they stopped selling. About a week after, 2 weeks after Liberation Day, they stopped selling and they started buying. Okay, and so we saw that pretty much exact bottom when they started buying. We saw that bottom in the S&P 500. So is there any question who controls prices in the market? There shouldn't be. Institutions absolutely control price movement within the market in the short term and the long term as well, but it's a lot more obvious in the short term. So when we look at this, we have perfect correlation between excuse me, between hedge fund manager allocations and movements in the S&P 500. So now that we got to this peak a couple weeks ago at the beginning of July, they hit 99.3, and then we saw this print back down 86.28. What we want to see is whether or not it's one of these incidences right here where it pops right back up and then we get that sell-off like this. It pops right back up and then we get the sell-off, or this is the beginning of the sell-off. So tomorrow's number, or I don't know exactly when they release it. So in the next couple of days, we'll get that number, and then either it'll be lower and we'll be a little bit more confident that that is their sell-off, and then we're getting that pullback in the markets, or it pops back up, we get a little bit of chop, or maybe it's even another all-time high in the markets, and then we start to see a sell-off. So either way, this number is indicating to me that a sell-off should happen relatively soon, within the next, well, maybe a couple days or 2 weeks after that, or 2 to 4 weeks after that. So we want to be very careful with our long allocations in this market. And then shorts, if we're doing shorts, we don't want to go completely against the trend. So they would have to be very short-term positions if we're going short. So you can see right here, that peak, okay, that has not translated into a downtick in the S&P 500 yet. But if this number keeps moving down, it will absolutely drag it down. Sort of like right here, okay, that downtick didn't correspond with the downward move. It just was a sideways move in the S&P. That's why we need to see. We need this, the next number. We need tomorrow/Thursday's number in order to really see that effect. But of course, we might already start to see it happening in the S&P 500. It's just a clue as to how deep that might go if we get that pullback. So if these guys start selling off into 80, then whatever, right? It's super minor. If we get a sell off more into 60, that is a more significant pullback. Okay, so for example, right here, August, this was January. So let's look at August and January. Okay, August, what was that? That was the Japanese carry trade. So if we measured that one, I believe that was pretty close to 10, yeah, right about 10%. And then January, okay, about 5 5%. So if we get that sell off to 50, 60, or to about 60, then we can expect 5 to 10%. I've been talking about 3 to 5%, and then we'll see if 10% becomes a potential. If they sell all the way down into 40 or lower, then we're really starting to talk about a correction. But right now, I still don't see that happening. So 10% would already be below the MA200. I think that's going to be pretty difficult unless there's just some big catalyst for a downward movement in the markets. Though 20% would be all the way back to where we were on Liberation Day. So I don't really see that happening. But for now, we just want to keep an eye on that. So is the market buying right now? Are there signs of buying in the market? The answer is no. Are there signs of selling? The answer is also no. So far, we have baby signs of selling with the NAIM, with the other ratios that we've been tracking. Not really, it's all been chopping sideways. So what I want to see again is that number, to repeat myself for the billionth time, is this next couple of days in this number, does it indicate a break below 80? And if so, then I'm going to start anticipating that pullback down to at least 3%, maybe 5% at this point in time, based on that number. Okay, so if I go 5% from today's high, that would bring me to the MA50. Not unreasonable at all. Not at all, especially given this run up. So, similar to this, pulls. Well, we went from below the MA200, so not an exact analogy. So, but it pulls back to the MA200. Let's find one where we broke below the MA200. This one run up. So this one was just a pullback to the 20 several times before breaking the MA50. So we could do that if the market is super strong, right? So we don't have to pull back to the MA50. And then this one over here, run up, pull back to the MA50 twice, actually, 3 times. Okay. So that's what we would expect. But the good news is the MA50 is not that far away from where we are. It's just 5%. So it's just a normal correction territory. Okay, or not correction, pullback territory. All right, let's see what you guys are saying. Learning something every day here. Good. I'm glad, Tim. How closely does that correlate with seasonality of market history? Depends what seasonality you want to look at, Barry. Do you want to look at every year? Do you want to look at presidential cycles? What is it that we want to look at? I think if we're looking at the year that we get a new president, this lines up with seasonality. So you have 2 strong quarters, and then in the third quarter you have a pullback, and then bullishness for the rest of the year. So far, this year is following that pattern. So it does line up, and based on the economics, everything that is going on, everything that we see in the market, it does, like, for my personal opinion and forecast for the rest of the year is bullish, is higher than what it's to have another significant all-time high above what we're seeing today. So maybe 650-ish, 660 is possible. Maybe even higher than that, but right now I'm going to make my estimate more conservative rather than less conservative. And a lot of that will do with the timing of the Fed and when they start cutting rates. So in general, the Fed rates don't drive markets, but they could create liquidity, and that liquidity could drive markets temporarily, short term, not for a super, super long time. So it's not like, oh, we made a bunch of money supply available and then all of a sudden it guarantees that markets are going to go up. All we have to do is look at China and know that that isn't true. It is more true of a pattern for specifically the US, but we want to look at things like the repo facility. Do I have Fred overnight repo? Mm, there we go. So this, I wasn't aware of this. That is interesting to me. And just so you guys know, I used to trade over like 100 billion of overnight repo every single day. So this is right up my wheelhouse and my territory. Uh, that is super interesting. Look at that spike versus everywhere else. Let's go 10-year. Yeah. So look how active this was during COVID. So we had a little bit of a crisis over here at the end of 2019, and then we went wild at COVID, and then we had this little blip right here. This was September, October of 2024. If you guys don't recall, September, October, it was immediately after that Japanese carry trade, we had another little freak out with banks, okay, with regional banks, and then we and then there was another freak out at earlier in the year. I think it was like March or May. There was that earlier freak out, but then we had a baby freak out in September, and then we had that Fed overnight repo window open. For they basically, that's a way for them to dump liquidity in the markets, and then you see that run up afterwards. So what happened over here more recently, and you can see that this and it was so quiet. No, there was no news whatsoever. No one was talking about this. That's interesting, which is probably why I missed it, because I don't look at this all the time. But that blip right there is large and significant. I mean, even towards the end of COVID era, it is higher than these blips over here. How do I can't scroll. I can't. Oh, I can. Sort of. Okay. So this high right here, 45, 6.5, 25, 9.6, and what is this? 11. So that's higher than that one, right about the same as this one. That is interesting that I need to do some research. It's interesting that they felt the need to open that overnight window. What it implies is that banks by themselves were not able to support their own liquidity. They couldn't lend among themselves with enough liquidity. And so they had to go to the Fed. And the Fed had to do $11 billion, basically give these banks $11 billion. Otherwise, they would have failed. Like, they wouldn't have been able to fund their withdrawals or whatever it is that they needed their cash for. And that was right at the very end of June. That's really interesting. Okay, so that money goes into supply, then it gets absorbed by the markets. So 6:30, and generally there's a delay. It's not going to be absorbed by it immediately. So interesting that the market didn't really do anything. It basically went sideways from there. So if they hadn't done that, then you can be sure that this would be a very different picture. We would have had that pullback, or maybe, I mean, the implication of them having to go to that overnight window is pretty strong. So it probably would have been more than a pullback at this point of time if they didn't do that. I wonder why they felt the need. I mean, who cares if they have a pullback above the MA 200? So there must have been some little bank crisis that didn't hit the news, that was kept very hush hush, that in order for the Fed to put in $11 billion. Now, in context, 11 billion isn't huge, right? So I told you guys that I traded 100 billion every day. Not with the Fed though, it was generally with other banks, because banks fund themselves. So, but the fact that we haven't seen that level since COVID, We don't have data before COVID, really. Um, the fact that we haven't seen those levels since COVID is a little disconcerting. I wonder if I'll even be able to find out what happened. I might have to tap into personal networks. I don't doubt I'll be able to do it with normal research. And they might not even tell me because they don't want that type of stuff leaked out. Anyways, that's really interesting. And what that implies to me is that we could get a rate cut sooner rather than later. Because if they felt the need to inject liquidity in the markets, then there's probably that same need, that same reason for them to stimulate the markets for a rate cut. So that this warrants paying attention to. If we get that rate cut, if it coincides with a pullback, then that would keep the pullback mild rather than potentially rolling into a correction or even a bear market, which at this point in time, the probabilities of seeing that bear market are quite low. This is something I'll see if I can get more information, but I sort of doubt it. But that is, if we can't get more information, at the very least, we can watch it very carefully and then see what starts getting priced into here in terms of rate cuts in September. Let's see what it says for October for now. So between 25 and 50 basis point rate cuts, we've actually have it like almost 80% right here. And then December, look at that. Okay. So 70, 80, so almost over 90% right there. But that includes, so if we get a rate cut in September, then basically all of this gets chopped off. Sorry, then this is already, all of this gets chopped off because that already happened. And so those probabilities have to shift into these two. Okay. Yeah, we'll want to watch this very carefully. And then not the overnight repo stuff because that event already happened. We just need to see the ripple effects into the markets. So for now, that NAIM number is indicating pullback. If we start seeing, actually, you know what? We will want to watch that Fed overnight repo because I want to see if they have to do it again. Especially if we have a pullback and they have to do it again, that's going to be really, really important information. Yeah, because the last time was September 2024, it was only 2 billion, 11 billion. Yeah, if they have to do it again, then that indicates short-term turmoil. And then later on, a few months down the road, rate cut possibility, and then stimulation of the markets higher. But also weakness in some sort of, within the banking system. So it could be hiding. So then we're basically kicking the can down the road for it. So that could be recession in 2026. But again, right now everything is speculation. Okay, just based on the overnight repo print right here. Interesting. Oh, definitely something that I will be keeping an eye on. Okay, let's see. I'm hoping for some negativity anyways. Got a few shorts in place. Okay. Maybe thinking interest by the Fed going lower. Treasury buyback announcement was today. That overnight repo action wouldn't be related to that. The only reason why we go to the overnight repo is because banks are having some sort of trouble. The overnight repo at the Fed. The overnight repo, banks do it with each other all the time. But overnight repo with the Fed, that is, as you could see from that chart, it was a lot less common occurrence. So So that all of that is painting a picture of, okay, looks like we might be imminent in terms of that pullback that we've been anticipating. It looks like the Fed is already starting to support this market despite, you know, it not cutting rates. They're doing other things. And then, so that implies a more mild pullback. And then what we want to take a look now is breadth. So if I look at bar charts and I go to breadth or market performance, now I'm going to start examining the relationship between the 50 and 200-day moving averages very carefully. Okay, so these two are getting close together on the overall S&P 500 index. We want to watch that carefully. What we want to see is whether or not this 50-day number gets below that 200-day number, or the 200-day number goes below 50. If so, then that is really weak for the S&P 500. If we get a pullback, but the 50 stays above the 200 and the 200 stays above 50%, then fine, mild pullback. Discretionary is getting kind of close as well. Okay, this is what I'm talking about. Consumer staples. At some point, this number got below this number. So that is bearish. Okay, so let's take a look at this chart. Yeah, it's came straight down. So the previous number before this was 42-ish, and then before that was 55-ish. And if we look at this number, the previous number was 34, and before that it was 36. So that 50-day is coming down, and it crossed below the number for the S&P 500. That means the short term is coming down to match the longer term sloping down. If you look at XLP, then that's not a healthy picture. So S&P has been mostly chopping, but right now we did break all these moving averages right here, but now we've just broken all of them again, and that low in that single bar, strong bar, is, if this keeps going, that's really bad news for staples, which is interesting because staples is supposed to be defensive. And if we get a pullback in the overall markets, the defensive is supposed to be one of the things that catch us. But let's see if we're not so far down that we would expect a high probability of pull up. We do, like we have from similar levels before, but we can definitely go further down on staples. Let's look at the 50. Yeah, we can definitely go a little bit further down. It's possible, just like in this area where we reverted, but it is equally, or if not more possible, that will come down even further, at least to this 18-ish level, 20-ish level, maybe as low as the 10 level. So staple is not looking good at all. And I want to see how much in danger we are in all the other sectors. Okay, so this is what might happen right now with that S&P 500, that 59, 55. Those numbers are getting really close together. So we want to watch that very, very carefully. And then let's see if there's any other interesting sectors. Energy is looking healthy, actually, in terms of, from that perspective. Look at this, financials. This was different. Financials looked strong last week, but the 50-day number pulled below the 200-day number. The only good thing right now is that this is still above 50%. Let's look at financials. Yeah, so starting to, its correction already, or its pullback already. Already pulled below the EMA 20, definitely weaker than the overall market. Whereas last week when we looked at it, it looked pretty strong, looked like it might bounce but it didn't. It chopped sideways and then broke down. So starting to see potentially some signs of weakness in the financials, which is not bullish. Healthcare looks like it could be, depends on if this is swinging up or swinging down. Maybe too early. I guess technically down. And let's take a look at the 200 sideways. Okay, so healthcare does represent a potential safe sector, even though it's beaten up right now. If money is coming out of financials, potentially coming out of tech, we'll take a look at that later, out of discretionary, they might go into healthcare as a safe haven. Okay. And we're basically chopping sideways in healthcare as well. Let's see. Do you think cryptos are playing an important role in this market? I'll take a look at that in just a moment. They were last week. We'll see in just a moment. Materials, still relatively healthy. I don't like seeing that below 50. Tech is not quite a threat yet. These are high numbers on both. Well, not super high over here, but this is high. I wonder if it's going lower though. Yeah, it's coming lower. So this could keep on coming down. And same, I think, with industrials. Yeah. So overall, it does look like in all the sectors so far that we've seen, except for maybe healthcare, that pulling back is a distinct possibility from a momentum perspective. Real estate is looking terrible. Let's take a look at this. Yeah, real estate is just really not looking good. Chopping sideways, but that momentum is not looking good at all. And then communications, now that's interesting. This made the crossover because communications was, we didn't look at the breadth yesterday, but I remember I had trouble. I said, technically, communications look strong. But then when I looked at the individual stocks in it, I was like, I couldn't find anything. So I would be very skeptical of this right here. This feels like it could fall through. Instead, if I just looked at pure technicals, it looks like a great pullback to the EMA 20 and bounce. Yesterday looked like a confirmation. Today, a failure. But if you could say, oh, well, maybe it'll bounce. You know, it just didn't launch the first time off of the EMA 20. Okay, based on today's bar and the momentum that we're seeing in it, it's looking a lot weaker. So if I had seen that the breadth yesterday, if I looked at it yesterday, I would have been, I'm, well, I came to the same conclusion because I couldn't find individual stocks that looked like they were doing what the general sector was doing. So that was the clue to me that, hey, that this is kind of not giving us a very good picture. But I could have saved myself looking at a bunch of individual stocks if I just looked at that momentum yesterday. So so I'd be very, very skeptical, very careful about communications. And then utilities also below. So this is not looking nearly as good as it did last week. Okay, because that 200 is kind of high. The MA50 crossed below it. This is looking like an incidence where the short term could drag down the long term. So I'd be very careful with XLU as well. So right now, the only, out of all those sectors that we looked at, the only one that looks somewhat like might be kind of okay if we start getting some sector rotation is healthcare. But based on this chart right now, I definitely wouldn't be entering into healthcare right now at this very moment. I would definitely wait until I saw that rotation happening, if it does happen, because this is technically very weak as well. So I don't know, what are the safe havens then inside of this market? Well, it's not going to be bonds, most likely. And gold, maybe. It's really just chopping sideways. We're not seeing it yet. And then so the question was, how about cryptos? Cryptos look strong. A little pullback into the EMA 8 because this was a really strong move. A little bit pullback is not unreasonable. Maybe even if it pulled back to here, that wouldn't be unreasonable. So in the medium to long term, crypto, or at least Bitcoin, looks fine, looks good. And it could be the safe haven. It could be the rotation sector of choice for, but not every fund, not every institution can invest directly in cryptos. So again, my preference when it comes to the crypto space now are those Bitcoin treasury stocks. So those are like the MSTRs. MSTR still looking excellent. Baby, just basically really just sideways movement into this very strong trend line right here. And then Mara, not as strong, but the pull a little. I mean, after this move up yesterday, look at that high yesterday, huge wick. Oh, pullback is not unheard of. It's still above the EMA 8, so there's nothing wrong with that. I think Galaxy was another one. Mostly chopping, but a little like the very, very beginnings of a trend, maybe, if it is going to trend. So this would be early on, and then clean spark. Yeah, so looking very similar. A lot of these Bitcoin treasury stocks are looking very similar. Riot, XYZ. Oh wait, is that? Yeah, XYZ. Hut. Riot looking very similar. We even kind of drew what would happen. Hut, very similar, just didn't pull back from as high, but yesterday at a high. So they're all moving very similarly, high correlation. And then XYZ, not nearly as strong. I would stay away from XYZ. And coin, yeah, coin, very, very, very strong as well. And is there another one? I think that was it. Yeah, I'm not really seeing. Nuclear stocks. Let's see how those are doing. NNE, beginning to maybe look interesting. Little trend developing right here. Okay, that EMA 8 curving up. Okay, after pulling back, curving up. NNE could be interesting. SMR. SMR much stronger, so very clearly bounced, and then yesterday a huge move, today continuation. That's a little too much too fast. So it's hitting resistance right here, could pull back, but if NNE is a little bit behind, it could move back to these highs right here, just like SMR did. And then I think OKLO. Yeah, OKLO. So it's like an average of those two. So right now it looks like OKLO, not bad at all. Although this is a little far away from the moving averages for my preference, you would have to give yourself like yeah, if you're doing a 1-to-1, is this a 1-to-1? Yeah, that's a 1-to-1. Not bad. Down to the MA50, and then these highs right here as your target. So what would happen is that if it pulled back and broke that EMA 20, then you would just exit, or right around place where it chops sideways and say, I was wrong, not take the full one one risk unit. Or the other thing that you could do is see if it went down to the MA50 and then bounced and then exit, take your loss a little bit later. So you're not going to expect recovery all the way because that would take a really long time. And if you're in options, that time decay would just completely eat you alive. But you could say, oh my gosh, I lost one risk unit, and then let it recover a little bit, then take your loss right there so it's not an entire risk unit down. And then if it just went up, then great. If it goes up and then pulls back near your entry point, or at that point in time, it'd probably be EMA 8 again. So if it pulls back to the EMA 8 before it hits that, then you put in a second allocation, right? And then that way you average in a winner. Okay, we never average in losers. You average in a winner, and then that way that's how you actually get, in practical purposes, you get a better than 1-to-1 reward risk ratio. You get like a 2 or 3-to-1 reward risk ratio by doing it that way, rather than just hey, I'll exit when it hits the target, or I'll exit when it hits the stop. Then you just have your 1-to-1. But if you did it the way that I just outlined, then for practical purposes, you've ended up with a 2 or 3 or maybe even a 4-to-1 reward risk ratio. So that's another way of approaching those reward risk ratios that maybe you haven't heard before. Okay. I don't think I've ever seen you use Fibonacci levels. Do you use that tool, or do I not trust it? I don't use Fibonacci at all. The reason why I don't use Fibonacci is because I've never seen any institution other than prop funds use Fibonacci's, which means there's not a lot of money behind Fibonacci's. So Fibonacci's will work really well with small cap stocks because it's mostly retail traders and prop firms trading it. But they won't work so well for NVIDIA, Apple, mega caps, S&P 500. You're not going to see Fibonacci's work that well. And you can, right, if I go SPY, I don't even know if I'll Fibonacci retracement. Okay, so did that Fibonacci work? Blew right through that red level. Okay, kind of blew right through this blue level too. I guess you could argue that it kind of hung out around here a little bit. Okay, yeah, I don't know. Okay, but if I use, let's find a random small cap stock. IWM. FN, never heard of that one. Or maybe even HIMS. What is HIMS small cap? Is that a small cap? Average volume 46 million. That's a lot of volume for a small cap. Market cap 11 billion, I guess. Yeah, I mean, let's try. Let's see. So I'll try FN and HIMS. Where would we even start? I guess right here. I pulled back off of the MA200 down to the bottom. Right here. I guess the actual low. Okay, so that kind of worked, right? That kind of worked. And then if I do it for HIMS, let's try this. Okay, so if I do that high down to that low, okay, yeah, that kind of worked. Okay, so that's what I mean. It'll work well, potentially work well for small cap stocks because large institutions aren't playing there. The really, really big guys, the guys who are managing billions and billions of dollars, they're not playing in this space. So your retail trader type of tools will work a lot better here because it's dominated by retail traders rather than by institutional traders. And in this case, I'm counting prop desks in the pool of retail traders rather than institutional traders. Um, okay, IBIT. IBIT would just follow Bitcoin. Yeah, so that we saw that happening in Bitcoin. What do I think of silver? Silver is actually kind of following Bitcoin. Let's see. Let's see it. BTC USD slash silver. Yeah, it's. I mean, they're following each other pretty well, at least in the last couple weeks. So that's kind of interesting. So, um, would I see silver as a safe haven though? No. If we start pulling back, Bitcoin could totally keep on going up, and silver most likely would not. So they probably break their correlation. Hood? Hood is to that's that's great. That is a really strong trend right there. Very, 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 very strong trend. Please press. Oh, yeah. Thank you, Naples fan. Thumbs ups are appreciated. Okay. CCJ. CCJ is looking very good. I just have to watch out for earnings. CEG. CEG, mild. Mild. This would be great for an income trade. Very mild, steady upward movement. It's a little wicky, but you don't care too much about that in an income trade. Yeah. NNE, I think we looked at NNE. Yeah. Okay. Yeah, if HIMS is popular, so but and small cap is so yeah, you can try using Fibonacci on there. I mean, it had a huge um, average volume. So yeah, I I would be okay. I don't use Fibonacci's, but I would be okay using something like a Fibonacci on HIMS, but I would not be okay using something like a Fibonacci on Apple, Amazon, Netflix, the Mag Sevens, super mega cap stocks. I wouldn't, or almost anything in the S&P 500. I probably would just, there are better ways to track institutional flow. Obviously. So basically, yeah, your best advantage in the mega caps is knowing what the large institutions are going to do. But that's not going to be your best advantage in small cap stocks because they're not playing there. So you find something else, like who are the major players inside the small cap stocks? And if it's retail, if it's mostly retail playing around in HIMS, then yeah, use your retail tools like Fibonacci's and Elliott waves and whatever. NEM dipped today. Oh wow, it did. That's just on news. Okay, so okay, see that MA50 right there? This is a great example. News like this, very specific news that does not necessarily affect the overall projection of the company, it doesn't affect their earnings or whatever. Of course, a CFO, I guess CFO. So could a new CEO or CFO completely change the direction of the company? Yeah, if they were super special or the person leaving was super incompetent, they could absolutely. But on average, those guys, they're if they're already out operating at that level, then they're probably pretty good at it. So it's kind of like saying, if you go to the Wimbledon, every single one of those tennis players are top notch. They're excellent. Are all of them going to be the champion? No, only one's going to be a champion. There's still going to be someone who differentiates themselves from the people who are there. But you can be pretty damn sure that they're all going to be playing really good tennis. Okay. So if I replace someone as a CEO or CFO, the person that's going in there is probably going to be pretty competent. And so I can be pretty assured that their performance as a company, especially in the short term, isn't really going to change all that much. Okay, so this is not necessarily, it's not like a long, or based simply on the fact that they change CEOs or CFOs, I cannot project forward and say, oh, well, now Newmont's going to do way worse, or now Newmont's going to do way better. In fact, my expectation is that they would do similarly until that new CFO or CEO proves themselves that they were really differentiating themselves from the rest of the CEOs in the market. So if that's the case, and I see this wild reaction right here, and especially if I see support holding like this, then my positive expectation is that within 2 to 4 days, Newmont is going to go back to doing exactly what it was doing before. And what was it doing before? Mild uptrend. Okay. So that MA50, if you had caught it intraday, beautiful, beautiful, beautiful entry points. Okay. Why? Well, simply because if I use the MA50 as the long term and the price as the short term, bam, bounced right off of it. Okay, so the short term reverting to match the long term. Now, since I didn't catch this, and I see this big bar still, and we still close below major levels, although we did close at a nice horizontal, not support right here, just above a nice horizontal support right here. Or we could argue this region, okay, region, not necessarily exact level, but region, okay. Then what I'd be looking for is that EMA 20 or the EMA 8. So either I'm going to be early or I'm going to be a little bit safer. When these two start moving upwards again, so that EMA 8 curls upwards, that would be the early entry. I'd go back into Newmont. And then a few days later, when the EMA 20 also moves upwards, then I could that was my more conservative entry, or I could add to my position if I allocated appropriately the first time. Like I didn't just blow my entire allocation in just one go. If I divided it into 2 or 3, then what I could do is this moves upwards, I go in with 1/3 allocation. EMA 20 moves upwards, I go in with another allocation, 1/3. And then when I see a pullback to the EMA 8 again, I go in for my last third allocation. And then I just ride this upwards. So news, it might be terrible and shocking on the day of, but it's very, very, very high chance this is just going to revert itself because all they did was replace a CFO. Right? Yeah. July 11th. I mean, he resigned like 4 days ago. He wasn't even today. But I guess the news didn't hit until today. So yeah, it's not going to be a long-lasting effect. So Newmont, actually, I mean, I'm going to start this. This is going on my list. I'm going to start watching Newmont. Yeah. Thanks for pointing that out. All right. GEV. We're going to wrap this up pretty soon because we got a very strong trend. Very difficult to find entries into this, and unless we get a pullback to that EMA 20. Yep. Large institutions have software to know exactly where prices will move and when, and that is how they can know several days ahead and see the future. Well, you can't really say that they know exactly when and where, but they get a good probabilities. Good probabilities. And more accurately, it is they have a plan. They always have a plan. So if I'm had a buy campaign on GE following this VWAP right here, yeah, I started buying over here on the dip, on the Liberation Day dip. Then I mean, technically, institutionally, I wouldn't have had a lot of opportunity. I might buy again right here. Okay, so if I buy here and I buy right here at this consolidation, then my average price is way down here. Okay. And then so what do I do? Like why where do I average down next? Okay, and what happens is they'll have targets. They know ahead of time. Okay, I'm hanging on to this for 5 years. I'm hanging on to this for 10 years. Or hey, there's a certain dollar allocation that I need to fill before I reverse this campaign. So maybe I only got 50 million over here and I got another 50 million over here, but I'm trying to fill in 250 million. Okay, so then we're going to positively expect that this is going to continue to have pressure to go up, and buying campaigns, every time you see it consolidate, is another area for that institution to buy more of it and then drive it even higher, drive it until they are done, or other people catch wind of it, other institutions or other or retail catches wind of it, and or example for this, like earnings happens, and then you see that sell off, and then the market dictated to the institution that, hey, you're not going to get your full allocation, because then they would just reverse and just sell what allocation that they had. But then that would, to them, that would be a failed campaign because they signaled too much. And other institutions or retail traders caught onto what they were doing, and they jumped in and made the price go parabolic before that institution had their full allocation. That would, even though they made money, they didn't make money on their full allocation. They didn't make nearly as much money as they wanted to. That would be considered a failed campaign. So Wall Street is trying to get in on their full allocation first, and then they will probe the market to see what happens. What if I sell? What if I sell? Is that going to cause a sharp movement downwards, or can I probe the market in a way that now signals to the general public that I'm buying a lot? So my last allocation, I might just go a little bit willy-nilly and just really drive up volume and drive up frenzy of prices, and then what happens is that something like bar chart will tell you right here, most actives, price volume leaders. Okay, so then I'm signaling to everyone, because I'm showing you my volume and price is moving up. Then we go a little crazy, like Nvidia. What happened there? Gap up today. Okay, that is probably going to get sold. Does it get sold all the way down? I don't know, but at the very least, it's going to get sold a little bit. It would be potentially the beginning of a sell campaign for some institutions, unless they haven't gotten their full allocation yet. So we would see. So then they actually do signal what they're doing. Buying frenzy ensues. Now they have people to sell to, and they reverse their campaign. Okay, so that's how that institutional flow works. So it's not necessarily that software is telling them, hey, dump all your shares at 170, okay? Because what would happen is they actually set their target somewhere near 170, and their goal is to get their full allocation well below that. So you see how it hit 170 today, but the AV-WAP is way down here at 127. Okay, so the AV-WAP is not exactly what they got, but it's a pretty good indication that on average, all of the buyers so far over here, they bought at 127. A lot of that's going to be institutional money. So the average price for institutions was 127. They've just made, 43 on 127. They made 33% or more. Yeah. As long as they've filled their allocation, they're going to be super happy to sell right here and just unwind it. They're not going to end up at 127 because they're not going to be able to sell everything right here. They're going to go on a sell campaign. But at some point in time, that average sale price is going to be above that average buy price. They're still probably going to make 30 bucks at least off of that. 30 off of the 127. Okay, so that's like 20, over 20%, less than 25%. That's pretty good from April to July. Okay, so that's how it works. It's not that I have software that tells me exactly where to sell. No, it's I'm done with my campaign, and the price has been driven up well beyond my average price in. It's time for me to flip and sell. That's how that works. What's a trading plan? How can I design one? Well, we are over time today, so I'll be sure to go over that over the next couple of days. But that's a great question. Golf business machine business. Has it ever happened to you that you're about to reach your target and for some reason, black swan, you've ended up losing more than you allowed? Well, if I'm about to reach my target, I've got a lot of room. You see that? It's got to fall from 170 all the way down to 127 for me to start losing money. So is there a black swan event that's going to cause NVIDIA to drop from 127 all the way to 120 or 170 down to 120 or 127? Probably not. Not an overnight one, right? And so they'll start unwinding, right? They'll start unwinding immediately. Plus, there's such a thing called hedging. So if you're doing this and you're hedging yourself properly, chances are you're not good. You will never experience that ginormous loss. But you'll experience loss, and it'll hurt. It won't feel good, and you might end up losing money on this campaign. And although in this case it'd be very unlikely because just how much room there is, but there could be other cases, right? Maybe we were only up here at 140 instead of 170, and then that happens, and then you lose money. Yeah, but it was all part of you hedged most of that risk away, so you should be perfectly fine. Otherwise, you didn't do your job right as an institutional fund manager. Okay. How do you put VWAP? I use anchored VWAP. So you just look up anchored VWAP. There's a whole bunch of them. I specifically use this one on TradingView. I use this one by Gene Clash. You can use any of the other ones. It's not. I mean, anchored VWAP is not anything proprietary or special. Okay. All right, guys. Great discussion. Great questions. We have a couple things to keep in mind. NEM is one of them. That overnight repo is one of them. And be careful. These momentum levels are not looking good. So the chances of pullback now is the highest it's been throughout this entire period. So I just be very careful going long. Don't go crazy on shorts either, because as of right now, still just expecting a 3 to 5% correction or a pullback so far. Okay, we're going to wrap it up here today. We'll talk about trading plans for the rest of the week or tomorrow, depending on how long it takes us to talk about that. So thank you guys. Enjoy the rest of your day, and I will see you guys later.